Welcome to another episode of The Funding Agency, the podcast that delves deep into the world of loans, financing, and empowering businesses to achieve their financial dreams. I am your host, Jason Feimster. I am thrilled to guide you through the labyrinth of loan brokering, showcasing the myriad of loan types you can broker to aid businesses in reaching their pinnacle of success. Our journey today is meticulously structured to bestow upon you a wealth of knowledge, drawing from concrete examples, verified facts, and practical experiences. Before we delve into the core of today's discussion, allow me to share a bit about my journey in the financial realm. With a decade long immersion in loan brokering and financial consulting, I've had the privilege of aiding numerous businesses to navigate their financial hurdles, securing the most befitting loans to propel their ventures forward. The pathway has been enriching, filled with learning, growth, and profound satisfaction of being a catalyst in the financial journeys of many. The essence of brokering transcends the mere transactions of securing loans. It's about being a financial architect, crafting solutions that echo with the unique financial narratives of each business, fostering a future of financial stability and growth. It's about demystifying the complex world of finance, making it accessible, understandable, and beneficial for businesses at every spectrum of the economy. Now, as the host of the Funding Agency podcast, it's an honor to share this platform with a community of listeners keen on delving into financial nuances, exploring the opportunities, and understanding the mechanisms that drive the financial engine of our economy. Our podcast series is a voyage through the vast ocean of financial topics where each episode is a dive into the depths of the financial instruments, strategies, and key players in the financial sector. Through engaging discussions, expert insights, and real world case studies, we aim to provide a well rounded understanding, igniting informed conversations around finance, loans, and the impactful role of brokers. Now, with a clear lens on what drives our discourse, let's transition into today's episode, where we will explore the diverse types of loans you can broker, unraveling the facets of term loans, SBA loans, lines of credit, and much more. It's about equipping you with the knowledge and insights to navigate the loan brokering landscape with confidence and acumen. So, without further ado, let's embark on this enlightening journey together. First, the broker's palette, diverse loans you can broker. As we venture into the realm of loan brokering, understanding the diverse array of loans available is paramount. It's the foundation of brokering with acumen, ensuring that businesses align with the right financial solutions tailored to their needs. Our first stop in this exploration is revenue based loans. Revenue based loans, a contemporary yet robust financing solution, offers a unique proposition. Unlike traditional loans, the repayment of revenue based loans is aligned with a business's revenue. A fixed percentage of monthly revenue is dedicated to loan repayment, creating a flexible repayment schedule that ebbs and flows with the business's financial tide. Now let's delve into the nuances of revenue based loans. Repayment structure. Revenue based loans have a dynamic repayment structure. The monthly repayments are a percentage of the business's revenue, which means during flourishing months, businesses pay more, and during lean months, they pay less. This creates a harmonious balance, ensuring businesses aren't overwhelmed during financial stringent times. Suitability. Revenue based loans are particularly suited for businesses with strong monthly revenues, especially those in a growth phase. They provide the fuel for scaling operations without the rigidity of fixed monthly payments. Terms and rates. The terms of revenue based loans vary, offering often ranging from 3 to 5 years. The rates can be higher than traditional loans due to the flexible repayment structure, typically ranging between 1.35 to 2.5 times the loan amount. According to a report from Lighter Capital, revenue based financing has emerged as a significant source of growth capital for early stage companies, especially in the tech sector. The report elaborates on how revenue based financing can serve as a bridge to traditional financing or even an alternative, providing businesses with the capital they need while retaining equity. Now, what sets revenue based loans apart is the alignment of the lender's and the borrower's interest. The repayment structure inherently supports the business's growth trajectory, making it a collaborative financial solution. As a broker, understanding the dynamics of revenue based loans and the kind of businesses they are suited for is crucial. It equips you with the ability to provide a financial solution that is not only flexible but empathetic to the business's financial journey. Next, term loans. As we journey further into the broad spectrum of loans you can broker, term loans beckon with a semblance of familiarity. They are perceived as conventional yet invaluable in the financial toolkit of many businesses. But what really encapsulates the essence of term loans? Let's unpack this traditional loan type. First, nature of term loans. Term loans are characterized by their straightforward structure. A lender provides a business with a lump sum of capital up front, which then is repaid over a specific term with interest. Terms range from short to long term, typically spanning from 1 to 10 years, or even longer in some cases. Usage. The allure of term loans lies in their suitability for long term investment. They are the go to financial resource for business expansion, capital expenditures, or even refinancing existing debt. The lump sum provided allows businesses to undertake substantial projects that are fundamental to their growth trajectory. Terms and rates. Interest rates for term loans are often determined by the creditworthiness of the business, the loan amount, and the term length. Rates can be fixed or variable, with fixed rates providing a predictable repayment schedule and variable rates potentially offering lower initial rates. Requirements. Acquiring a term loan requires a solid credit history, a robust business plan, and often collateral. Lenders seek assurance in the business's ability to repay the loan over a specified term. A report from the Federal Reserve's 2019 Small Business Credit Survey indicates that 50% of small employer firms had outstanding debt, with term loans accounting for a significant portion of this debt. The data underscores the pivotal role of term loans play in fueling businesses, especially small enterprises. Now, as a broker, understanding the mechanics of term loans, the requirements, and the type of businesses they serve is crucial. It's about matching the long term financial needs of a business with a loan type that provides the necessary capital to meet those needs while ensuring a manageable repayment structure. Next, Small Business Administration, or SBA loans. In the realm of small business financing, a few loan types evoke a sense of security and support as Small Business Administration, or SBA loans. Crafted with the intent to bolster small business growth, these loans come with the backing of the U.S. Small Business Administration, a notable endorsement that alleviates the risk for lenders while providing competitive terms for borrowers. Nature of SBA loans. SBA loans are not directly lent by the U.S. Small Business Administration. Rather, they provide a guarantee to lenders for a portion of the loan, reducing the lender's risk. This setup encourages lending institutions to provide loans to small businesses that may have been considered too risky otherwise. Usage. The versatility of SBA loans is laudable. They can be utilized for a plethora of business needs, including working capital, purchasing equipment, buying real estate, or even refinancing existing debt. Broad applicability makes them a revered choice among small business entrepreneurs. Terms and rates. The terms of SBA loans are highly competitive, often extending to 10 to 25 years with interest rates that are usually lower than many other types of loans. The exact rate and terms are contingent on various factors, including the amount borrowed, the term of the loan, and the financial standing of the business. Requirements. Qualifying for an SBA loan demands a strong credit score, a sound business plan, and often collateral. The process can be rigorous, but the favorable terms are often worth the effort. The Small Business Administration's report on lending activity reflects a substantial 22.5 billion in approved 7A loans, SBA's flagship loan program, for the fiscal year 2019. This statistic is a testament to the significant role SBA loans play in propelling small business ventures. Navigating the intricacies of SBA loans as a broker is a voyage of understanding the symbiotic relationship between governmental support, lender confidence, and small business growth. It's about fostering a rod where small businesses thrive, contributing to the economic fabric of our communities. Next, lines of credit. Transitioning from the structured realm of term loans and SBA loans, we venture into the flexible domain of lines of credit. A line of credit, often likened to a financial safety net, provides businesses with access to a set amount of capital from which they can draw whenever the need arises. The allure of lines of credit in its inherent flexibility and readiness, acting as a financial cushion in times of cash flow crunches or unexpected expenses. Nature of lines of credit. Unlike traditional loans where a lump sum is dispersed, a line of credit allows businesses to draw funds up to a specified limit, paying interest only on the amount drawn. It's akin to having a credit card with a defined limit and the ability to use the funds as and when required. Usage. Lines of credit are quintessential for managing cash flow, handling expected expenses, or seizing new business opportunities. They provide a reservoir of funds that can be accessed to smooth out financial wrinkles, ensuring business operations run seamlessly. Terms and rates. The terms of lines of credit are varied, with some being revolving, allowing businesses to draw, repay, and draw again. Interest rates are typically variable, dependent on the market conditions and the financial standing of the business. Requirements. Acquiring a line of credit necessitates a good credit score, a positive business financial history, and often collateral. Lenders seek assurance in the business's ability to manage the line of credit responsibly and repay the amounts drawn. The 2021 Small Business Credit Survey by the Federal Reserve Banks reveals that lines of credit were among the top financing products sought by small businesses, underlying their pivotal role in managing financial fluidity. Mastering the dynamics of lines of credit as a broker is about appreciating the fluidity that they offer to businesses. It's about aligning businesses with the financial resource that provides not just capital, but the freedom to manage that capital in a way that resonates with their operational tempo. Next, equipment financing. Veering into a sector specific financial solution, equipment financing stands as a beacon for businesses in need of modern, functional, or specialized equipment. This loan type is structured meticulously to cater to the acquisition of equipment, which in turn serves as collateral, minimizing the risk for lenders and facilitating favorable terms for borrowers. Nature of equipment financing. Equipment financing is tailored for the purchase of equipment. The equipment itself acts as the collateral for the loan, which means that if the business fails to repay, the lender can reclaim the equipment to recoup the loss. The self-securing nature often translates to lower interest rates and better terms. Usage. From manufacturing machinery, vehicles to high-tech IT equipment, equipment financing is the conduit through which businesses can modernize, enhance productivity, or expand operations. It's the fuel for driving operational excellence and competitiveness. Terms and rates. The terms of an equipment financing loan often mirror the expected lifespan of the equipment, with interest rates that are competitive, often ranging between 8 to 30%, contingent on various factors including the credit worthiness of the business, the lifespan of the equipment, and the overall financial landscape. Requirements. To qualify for equipment financing, businesses need a solid credit score, a detailed proposal of the equipment to be purchased, and its anticipated impact on business operations. According to a report from the Equipment Leasing and Finance Association, the equipment finance market in 2019 accounted for approximately 22% of business investment funding for equipment and software in the United States. This statistic accentuates the significant role equipment financing plays in fueling business operations and driving industrial modernization. As a broker, navigating the equipment financing landscape is about understanding the nuanced needs of the businesses in different sectors and aligning them with the financial solution that propels operational efficiency and growth. Next, merchant cash advances. As we traverse the diverse landscape of financial solutions, merchant cash advances, or MCAs, unfold as a distinct route for businesses with high credit card sales volume. This financial mechanism is crafted for immediacy, providing businesses with a lump sum of capital upfront, which is repaid by withholding a percentage of daily credit card sales. Nature of merchant cash advances. MCAs are not loans, but advance payments based on a business's future credit card sales. The repayment is automated with a fixed percentage of daily credit card sales remitted to the lender. The structure provides a cushion for businesses, aligning repayment with revenue generation. Usage. MCAs are suitable for businesses in need of swift capital injection to address immediate needs such as inventory of purchase, seasonal preparations, or unexpected expenses. They are particularly appealing to retail and restaurant sectors where credit card transactions are a significant portion of revenue. Terms and rates. The cost of an MCA often denoted by a factor rate, which typically ranges from 1.1 to 1.5. The repayment term is not fixed but fluctuates with the business's daily credit card sales, generally concluding within 4 to 18 months. Requirements. The primary requisite for an MCA is high volume of credit card sales. Unlike traditional loans, credit score requirements may be more lenient, making MCAs an accessible option for businesses with less than stellar credit. A study from the Federal Reserve Bank of Cleveland highlights the growing utilization of MCAs among small businesses, underscoring their appeal as a quick financing solution, albeit at a higher cost compared to traditional loans. Navigating the MCA landscape as a broker is akin to walking a tightrope, balancing the immediate financial needs of a business against the cost of capital. It's about discerning the rhythm of the business's cash flow and aligning it with a financial solution that echoes its operational tempo. Next, commercial real estate loans. Among the vast spectrum of financial solutions, commercial real estate loans shine a light on the pathway for businesses aiming to acquire, refinance, or develop commercial properties. These loans are tailored to meet the distinct needs of commercial real estate ventures, serving as a cornerstone for businesses looking to expand their physical locations or investors aiming to grow their real estate portfolios. Nature of commercial real estate loans. Commercial real estate loans are specifically designed for the acquisition, refinancing, or development of commercial properties. These properties could range from office buildings, retail spaces, to industrial or multifamily residential complexes. The loan is secured by the property itself, which serves as collateral. Usage. These loans are instrumental for businesses looking to expand for operational footprint or real estate investors aiming to enhance their portfolios. They provide the capital necessary for purchasing new properties, refinancing existing ones, or undertaking development projects to augment the value of the property. Terms and rates. Terms for commercial real estate loans often range between 5 to 20 years, with amortization periods extending even longer. Interest rates can be fixed or variable, generally lying between 3 to 7%, contingent on various factors, including the creditworthiness of the borrower and prevailing market conditions. Requirements. Acquiring a commercial real estate loan demands a strong credit score, a solid business financial history, and significant amount of equity in the property. The process often entails a thorough evaluation of the property and the financial projections associated with it. A report from the Mortgage Bankers Association highlighted that in 2019, commercial and multifamily mortgage bankers closed $601.9 billion in loans. The staggering figure underscores the pivotal role commercial real estate loans play in fueling the real estate sector and, by extension, the broader economy. Embarking on the journey of brokering commercial real estate loans is about delving into the nexus between business operations, real estate investment, and financial facilitation. It's about forging a pathway for businesses and investors to realize their real estate aspirations, contributing to the economic vibrancy of our communities. Next, invoice finance factoring. Delving into the realm of invoice factoring, we uncover a financial solution tailored to address cash flow challenges faced by many businesses. Unlike traditional loans, invoice factoring is a mechanism where businesses sell their outstanding invoices to a third party company, known as a factor, for immediate cash, bridging the cash flow gap in undergoing by slow paying customers. 1. Nature of invoice factoring. Invoice factoring is not a loan, but rather a financial transaction where businesses sell their outstanding invoices at a discount to a factoring company. This process provides immediate cash to the business, aiding in managing cash flow and meeting their immediate financial obligations. Usage. Businesses often resort to invoice factoring to ease cash flow constraints, enabling them to meet payroll, handle operational expenses, or seize growth opportunities without waiting for customers to pay their invoices. Terms and rates. The cost of invoice factoring is usually defined by a factor rate, which is a percentage of the invoice amount. The rate can range from 1 to 5% per month depending on various elements such as the creditworthiness of the business's customers, the total value of invoices, and the industry the business operates in. Requirements. To qualify for invoice factoring, a business needs to have outstanding invoices from creditworthy customers. Additionally, the business should be free from legal problems or tax issues. A study by the Commercial Finance Association reveals that the factoring volume in the United States amounted to $116 billion in 2018, depicting a growing trend in businesses opting for invoice factoring to alleviate cash flow bottlenecks. Embarking on the journey of brokering invoice factoring solutions requires an acute understanding of the cash flow dilemmas faced by businesses and the ability to align them with a factoring company that resonates with their financial rhythm, ushering in a realm of financial stability and growth. Next, asset based loans. Advancing further into the spectrum of financial solutions, asset based loans emerge as a potent avenue for businesses seeking working capital. With a structure rooted in the business's assets, this type of loan provides a safety net for lenders and a source of timely capital for borrowers. Nature of asset based loans. Asset based loans are secured by a company's tangible or intangible assets. These assets can range from accounts receivable, inventory, machinery, to intellectual property. The loan amount is typically a percentage of the appraised value of the secured asset. Usage. Asset based loans are instrumental in providing working capital for managing day to day operations, funding expansions, or navigating through transactional phases such as mergers or acquisitions. They are often sought by businesses in need of immediate capital to fuel growth or manage operational expenses. Terms and rates. The terms of asset based loans can vary widely, often dictated by the nature and value of the assets securing the loan. Interest rates are usually competitive, contingent on the creditworthiness of the business and the quality of the assets. Requirements. Qualifying for an asset based loan necessitates having valuable assets, a solid financial standing, and a track record of operational excellence. Lenders will conduct a thorough evaluation of the assets and the financial health of the business. According to a report by the Secured Finance Network, a total asset-based lending volume in the U.S. reached $422 billion in 2018, illuminating the significant role of asset-based loans in facilitating business operations and fueling economic growth. Navigating the asset-based loans landscape as a broker is akin to being a financial architect, structuring loan solutions that resonate with the intrinsic value of a business's assets, fostering a conducive environment financial stability and growth. Next, microloans. Transitioning to a financial avenue that echoes the ethos of community and small scale empowerment, microloans emerge as a beacon of hope for startups and small scale operators, often facilitated by nonprofit organizations with a community development focus. Microloans provide a financial stepping stone for entities serving and striving to make a meaningful impact in their local areas. Nature of microloans. Microloans are small loans typically ranging from 500 to 50,000, aimed at assisting small businesses, startups, or individuals who might not qualify for traditional financing. They are often facilitated by community-based organizations with a keen focus on local economic development. Usage. Microloans are instrumental in providing capital, starting or expanding small businesses, purchasing inventory or equipment, or even working capital. They provide a financial launchpad for small-scale endeavors aiming to make a mark in their communities. Terms and rates. The terms of microloan can range from short to medium term, often up to 6 years, with interest rates varying widely based on the lending organization and the region. The rates are often competitive, making microloans an attractive option for small-scale entrepreneurs. Requirements. Qualifying for a microloan entails having a viable business idea or a small business with a promising outlook. The application process often includes a thorough review of the business plan and a personal credit check. According to the data from the U.S. Small Business Administration, their microloan program had an outstanding loan balance of over 76 million at the end of fiscal year 2019, underscoring the significant role microloans play in fostering small business growth. Delving into the microloan landscape as a broker is about embracing the essence of community-centric financial solutions. It's about connecting aspiring entrepreneurs with the capital they need to turn their visions into tangible, community-enriching ventures. Next, trade credit. Venturing into the realm of trade relations, trade credit emerges as a vital cog in the wheel of business transactions. It's a form of credit extended by suppliers, allowing businesses to purchase goods or services on account and pay for them later. This mechanism not only fosters trust between businesses and suppliers, but also provides a cushion for managing cash flow. Nature of trade credit. Trade credit is an agreement between businesses and their suppliers, where the suppliers allow the businesses to pay for goods or services at a later date. Terms of the payment can range from net 30 to net 90 days or even longer, depending on the agreement. Usage. Trade credit is instrumental in managing cash flow, ensuring that businesses can continue their operations without disruptions, even if there's temporary cash crunch. Also assists in establishing a credit history and rapport with suppliers, which is crucial for business sustainability and growth. Terms. The terms of trade credit are negotiated between the business and the supplier, often stipulated in the supplier's payment terms. Common terms include net 30, net 60, or net 90 days, indicating the time frame within which the payment should be made. Requirements. Establishing trade credit often requires a good business relationship and trust between the supplier and the business. It's often beneficial if the business has a positive credit history and a track record of timely payments. A study by the National Association of Credit Management underscores the significance of trade credit, revealing that for many companies, trade credit is the largest use of capital after fixed assets and inventory. Navigating the intricacies of trade credit as a broker is about understanding the symbiotic relationship between businesses and suppliers. It's about fostering a relationship where businesses can thrive, bolstered by trust, financial flexibility, and mutually beneficial trade relations. Next, franchise financing. As we traverse the financial avenues available for aspiring entrepreneurs, franchise financing unveils itself as a tailored solution for those venturing into the franchising realm. This specific financing option caters to the unique needs of purchasing, expanding, or upgrading a franchise, providing a financial scaffold on which franchise dreams can be actualized. Nature of franchise financing. Franchise financing is structured to cater to the cost associated with opening, operating, or upgrading a franchise. This includes franchise fees, equipment purchases, and operational expenses, among others. The structure and terms of franchise financing are often influenced by the franchisor, the franchisee's creditworthiness, and the franchise's profitability. Usage. The financing solution is vital for entrepreneurs looking to purchase a new franchise, expand their existing franchise operations, or upgrade their franchise to meet the franchisor's current standards. It provides the financial backing necessary to navigate the unique franchise landscape successfully. Terms and rates. The terms and rates of franchise financing can vary widely, often spanning from 5 to 10 years, with interest rates ranging from 5 to 30%, contingent on various factors like the franchise's performance, the franchisee's credit standing, and the overall economic environment. Requirements. Acquiring franchise financing demands a solid credit score, a compelling business plan, and often a certain level of experience in managing a business or franchise. The approval process often entails a thorough review of the franchisee's financial standing and the franchise profitability prospects. According to a report by the International Franchise Association, franchising is responsible for over 7.6 million direct jobs and 674 billion of economic output in the United States. The data underscores the pivotal role franchise financing plays in fueling the growth of franchise sector, contributing significantly to the economic fabric. Venturing into franchise financing domain as a broker is about aligning aspiring franchisees with financial resources necessary to thrive in the franchising area. It's about building bridges that connect entrepreneurial aspirations with viable, profitable franchising opportunities. Segment 2, Brokering with Acumen, Procedures and Best Practices. As we venture into the second segment of our discussion, the realm of brokering unfolds with a blend of art and science, entwined with ethics and due diligence. The path of brokering is paved with meticulous procedures and best practices that ensure not only the financial feasibility of loan transactions, but also their adherence to legal and ethical standards. Aspiring brokers, the initiation journey. The expedition of an aspiring broker commences with a profound understanding of the diverse loan types, alongside gaining insights into the regulatory framework governing the brokering landscape. Acquiring relevant certifications, engaging in professional development courses, and aligning with seasoned mentors in the field pave the way towards brokering with acumen. Common procedures, the blueprint of brokering. Every loan type comes with its set of boundaries, from the initial client consultation, assessing the financial standing of the business, to choosing the appropriate loan type and lender. The journey is marked with meticulous analysis and strategic decision making, ensuring a transparent communication channel with the client and adhering to the regulatory compliance are the linchpins of successful brokering. Legal and ethical adherence, the pillars of trust. The essence of brokering transcends the financial transactions and delves into the realms of trust, ethics, and legal adherence. Upholding the highest standards of integrity, ensuring confidentiality, and adhering to the legal mandates not only foster trust, but also safeguard the interest of all parties involved. Continuous learning and adaptation. The growth paradigm. The financial landscape is ever evolving, mandating a continuous learning and adaptation ethos among brokers. Staying abreast of the latest industry trends, regulatory changes, and emerging loan types is pivotal for providing top-notch service and fostering long-term success in the brokering domain. Segment 3, the broker's impact, facilitating financial solutions for business success. Unveiling the third chapter of our discourse, we navigate through the impactful avenue brokers carve in the financial landscape. The essence of brokering transcends the transactional realm, venturing into a territory where financial solutions are crafted, tailored to fuel the engine of business success. Bridge between dreams and reality. Business loan brokers serve as a conduit between businesses and financial institutions, decoding the financial aspirations of businesses and aligning them with the financial solutions that propel them towards their objectives. It's about understanding the unique financial fingerprint of each business and orchestrating a financial solution that resonates with their goals. Long term benefits beyond the transaction. The impact of a broker extends beyond facilitating a loan transaction. It's about establishing long term relationships, providing financial guidance, and being a reliable financial ally for businesses. By ensuring a match with the right loan product, brokers pave the way for sustainable business growth and financial stability. Mastery over loan types, a spectrum of solutions. Mastering different loan types enhances a broker's ability to provide value to both businesses and financial institutions. It's about having a diverse financial palette from which tailored solutions can be crafted, addressing the unique financial needs and circumstances of each business. As we draw the curtain on today's enlightening discourse, the landscape of loans and the essence of brokering echo with a resonance of potential, opportunity, and financial empowerment. From the diverse palette of loans to the meticulous art of brokering, the journey is rich with knowledge, insights, and the promise of facilitating financial solutions tailored to business success. We traverse through the nuances of various loan types, each with its distinct character, purpose, and potential. We also delved into the realm of brokering, exploring the procedures, ethical considerations, and the impactful role brokers play in bridging businesses with financial solutions. The financial landscape is dynamic, ever evolving with market trends, regulatory changes, and economic shifts. For brokers, the journey of learning and adaptation is continuous, demanding a keen eye on industry dynamics, a commitment to ethical practices, and a passion for facilitating financial success for businesses. As we continue to explore the vast domain of financial brokering and our upcoming episodes, we invite you to engage with us. Share your thoughts, experiences, and questions on our platform. Your insights enrich the discourse and foster a community of learning and collaboration. A heartfelt thank you for tuning in to the Funding Agency Podcast. I'm your host, Jason Feimster, and it's been a privilege to navigate through the world of loans and brokering with you. Until our next episode, keep exploring, keep learning, and keep striving towards financial empowerment.